What's up, guys? It's Japa Rico here, broadcasting live from Hong Kong, and thanks so much for all of you who are participating in this live event. And okay, so let's not waste any time. Let's start the seminar. Um, okay, guys. So let me present this. I hope you guys are able to see this screen. And let me just check here if the audio is okay, everything is okay. Just a minute, let's see. Just 1 minute, guys. Just 1 minute, guys. Let me just check. Okay, so everything looks all right. Way beyond the markets. The first thing that happens when you push a button, I think everybody, if not everyone, almost everyone here knows how to place an order in a brokerage firm, okay? So let's say you open your account, you got your account ready to be used, and you have two choices. You have the buy button and the sell button. For the buy button, I think you guys already know. So you push the button, you expect the price of the asset. Could be a stock, could be an index, it could be a currency pair. You expect the price of this asset will appreciate in value. That's why you push the buy button. And if it appreciates, you close your order, you make that much of the difference, and you make profit. What some of you may not know is what happens when you push the sell button. When you push the sell button, that happens when you think the asset is going to go down. So you start the position selling, and if the asset goes down, you make money, okay? But wait a minute, what really happens? Like, everybody knows how to use the platform, but not many people know what really happens in the background. So let's take a look at what really happens. Who controls the market? Okay, let me see if I can put I'm not sure. Okay, just 1 minute, guys. Not sure if I can put my face here somewhere. Can I put my face? Camera effects. Not sure if I can somehow add oh yeah, I think I can add my face. Can I? Current cam live events, entire screen. Okay, I think it will take, okay, let's just forget it. It will take some time for me to figure out how to put my face somewhere. So it's okay. Let's go to the next slide. Okay, who controls the market? So the Intercontinental Exchange, ICE, owns the NYSE, New York Exchange, and Euronext. The Chicago Mercantile Exchange, CME, owns the Chicago Board of Trade, CBOT, New York Mercantile Exchange, NYMEX, and COMEX. So there is a monopoly, I would say a duopoly. Two companies control the market. And this was my setup, my computer back in 1996 when I first started trading. So you can see it was not even a Pentium. It was, wow, I got this, I actually got this picture somewhere from the internet. It's not really my setup, but my setup was something very similar to this one. It was not even a Pentium. It was a 486 Intel computer. What has changed from 1996 to 2021? Back in the days, I was using a dial-up connection. I had 2 megs of RAM, 100 megs of hard disk. I didn't have a smartphone. There were no smartphones in 1996, and I used to use a dot matrix printer. By that time, most of the orders were being placed by phone or fax. Internet, like orders placed via internet, was still a very new thing back then in 1996. Most people didn't used to use it. They prefer, instead of placing orders on the internet, they used to prefer placing orders on the phone or via fax. A lot of my friends, they used to place orders via fax. I remember very well. Now in 2021, most of the orders, I would say actually almost all the orders are being placed via internet. And you have broadband connections, 5G. You have most computers, at least from 8 to 64 gigs of RAM. You have huge hard disks now that are very fast. They're being manufactured using SSDs. We have smartphones. We have laser printers. Back in 1996, if you say laser printer, that would be like if you say, "Oh, I'm using a laser printer at home," that would be really rare. Okay, but nowadays anybody can have access to a laser printer. But the thing is, guys, none of these things will make you a better trader. Okay, so if you have a fast internet connection, it doesn't mean you're a better trader. If you have a laser printer, if you have a lot of RAM, if you have the fastest smartphone, okay, ever, it doesn't make you a better trader. Why? Because it will still be you, right? It still be yourself placing the trades. No matter how fast your connection is, no matter how fast your smartphone is, it still be yourself placing the orders. None of these things will make you a better trader. So changes, evolution in technology doesn't make you a better trader. Regulators. Let's talk about regulators. So I always say that regulators in this market, they're always passive and reactionary. Okay. Back in 2010, CFDs, contracts for difference, CFDs were banned in the USA. Okay. Why do you think they were banned? That happened because you know that subprime, right? Subprime took place in 2008, 2009. And after that, what the government noticed is that people lost a lot of money trading CFDs. So because people lost a lot of money, the US government decided, and that was during the subprime. So because of that, what happened during the subprime crisis, the US government decided to finally, in 2010, to ban CFDs from the US. Also in 2010, IB contracts, introducing broker contracts were banned in Singapore. In 2016, Belgium and Israel banned OBs, should be BO, binary options. So Belgium and Israel banned binary options, and in 2018, the European Union also banned binary options, okay? So you have the ESMA. The ESMA is what regulates trading in the European Union. So they decided to ban binary options. Do you think they banned binary options because people were making a lot of money? No, people were losing a lot of money, okay? So people were losing a lot of money and people started to complain to the government, and then the government decided to ban binary options. So what I say is that regulators always take action after an event. Okay, so after a lot of people have been cheated, a lot of people have been losing money, then finally regulators will take action. Here we are going to show you professional trading knowledge that professionals don't want you to know. One thing, let's take a look at this chart. Okay, so here I have a comparison between a professional trader, for example, a hedge fund manager, HF manager, hedge fund manager, and let's compare that to retail traders, okay, also called sardines. It's a colloquial term, sardines, or recently people also call them losers, okay? So what's their approach? If you're a professional trader, you will be more systematic. You have a systematic portfolio with multiple positions, okay? So I always say this when, let me get back to let me get back to the camera. So I always say this to you guys. So when you have a professional trader, the professional trader will always take care of multiple positions at the same time. So he or she, they will manage multiple positions. On the other hand, if you take a look at the retail trader, usually he or she will manage like one position, or at most like two positions. It's not many, okay? So and of course, like when you took, let's go back to this. So the professional trader will use both fundamental and technical analysis and will be positioned from like a few weeks until a few months, right? On the other hand, if you are a retail trader, usually the retail trader will be directional approach, okay? So you'll think, okay, I will go invest in this because I think it will go up, I invest in that, and because I think it will go down. There is no system. And I always tell people you need a system, and you need to back test your system. You need to make sure that your system works. And when I say system, I don't only mean automated systems. It could be a manual system, okay? But you need a system, you need a method that has been proved to work, that has been already back tested, and you have been using it in order to generate consistent profits, okay? The retail trader doesn't have that, and usually the retail trader is not positioned for a few weeks or months. The retail trader, on the other hand, likes to do scalps or day trading, right? So that's why I put here scalp and day trading. They love that, okay? And they have concentrated risk for one or only two or three positions at most. They do a lot of technical analysis. They do the entries based on gossip. Okay, recently a lot of you have heard of Wall Street bets, like the thread on Reddit. So they do a lot of entries based on gossip and based on feelings. Okay, and what do I mean by feelings? It's like, oh, I feel it, and this happens when I listen to what, because you know, I have a YouTube channel, and a lot of retail traders contact me, and then when I ask them, why are you taking this trade? Why are you taking that trade? They often say to me, oh, Japa, you know, I have a feeling, man. I don't know how to explain, but I have a feeling this will go up, or I have a feeling this will go down. Or, oh, I heard somewhere that this will go up. Like, oh, my friend told me this will go up. The friend of a friend told me it's going to go up. My dog told me it's going to go up. My neighbor, whoever. Okay, so there's a lot of based on gossip and feelings that come from the heart, or I have no idea where they come from exactly, but they are a lot of entries. Okay, are based on feelings. And this is exactly what professional traders don't do. The professional traders have a systematic approach. They have a system, so nothing is based on feelings, okay? Nothing is based on emotions. Risk management. The professional trader will try to diversify, so diversification and risk management. And I always say here that you don't do diversification as your main purpose, okay? And I hate when people say, oh, we need to diversify. So that's not what happens. What happens is that you spot opportunities according to your system, and then you end up diversifying. Okay, so diversification is not the main purpose, but is actually a consequence of you managing multiple positions at the same time. Okay, so when you are managing as a professional trader, you're managing multiple positions, so you end up diversifying. Okay, but diversification is never the main purpose. Okay, so watch out what I'm saying, and usually people. Professional traders have multiple positions from 10 to 20 positions. Like this is just like I wrote. Some of them, of course, have more than that, but just I wrote as for you as a reference. Uh, Retail traders, on the other hand, they have concentrated risk. So they only open one position, they put all their money there, and they expect it will go up, okay? And somehow, if it doesn't go up, they start to pray. They start to pray and say, oh, please go up, please God, or please, I don't know who they believe in, but they say, please God, please, I hope it will go up. Or if they sold the position, they say, oh, please, it has to go down, it has to go down. So it's concentrated risk, okay? Let's talk about the returns. So professional traders will have consistency. They will reach consistency in long term. So they never expect a return in very short periods of time. They always expect to reach consistency, being consistent along years. Okay, so it's along years of trading in markets that they know that they are going to finally reach consistency. Of course, that if they are already a professional trader, they're already consistent. They have been already consistent for many years. Okay, and they know that the consistency, when they were still learning the process, they know that it can only be reached after long periods of time. Okay. The retail trader, the typical retail trader, on the other hand, doesn't think like that. So the typical retail trader, they want short-term results, okay? So they want short-term results. They want to find something like the Wall Street bets, the GameStop, right? Everybody's talking about GameStop. So they want to find something like GameStop, hundreds of percent in just a few hours. Yay! Let's make a lot of money. Let's become a millionaire in just a few hours. Why not? Like everybody wants that, okay? And the outcome everybody knows. So those retail traders will reach destruction of their capital. They'll blow up their accounts. Goodbye, c'est fini, adios, right? And the outcome for professional traders, they'll have capital preservation and they will achieve capital growth in long term. And I always say that professional traders, we work based on risk-adjusted returns. So we follow the oscillations of the market, we follow the volatility of the market, and because we have a system, right? Once again, because professional traders, we have a system that we use, that we've been using for years and years. We have systems that help us to calculate the variation, the oscillation of the market, the volatility of the market, and we set our entries, our stops based on the variation of the market that can be based on volatility, volume, and a lot of things. For example, the ATR, the average true range indicator, that calculates the true movement of the variation of the price of the candlesticks and other things like that. So the system will help you to automatically calculate your risk, okay? So your risk is being calculated. On the other hand, okay, so that's what I always say, that we work based on risk-adjusted returns. Okay, so our returns are all based on mathematical calculations based on this proven system, okay, that has been proved to work well for long periods of time, okay. On the other hand, retail traders don't have a system, and because they don't have a system, they don't have risk-adjusted returns, okay, and because they don't have risk-adjusted returns, they don't know. And I always say this, you need to know how to work with risk. That's the key thing for you. Whenever you look at the markets, you need to know how to deal with risk, because the market is all about volatility. It's all about how you manage the risk, okay? There's even an exam called FRM, Financial Risk Manager, Okay, so in that exam, qualification exam, you learn things about how to manage, how to control the risk. And trading is all about controlling the risk. Mindset. Talking about mindset, guys, the professional trader or hedge fund manager versus the retail trader. The professional trader has realistic expectations, calculated targets, as I mentioned just before about calculating your risk. Retail traders have no realistic targets. They have the millionaire dream. Okay, oh, I will start trading the market today and I'll become a millionaire in a few weeks or a few days. Yes, right? They have unclear targets when you ask them. You ask a retail trader, how much, okay? What's your goal? What do you expect? What's your target? They don't know. They say, I don't know. As far as I can go. They don't know. They have unclear targets. Professional traders, we have consistency reached in long term. I just said that. Retail traders, they have a mindset that will make them become poor, even though they don't. Okay, even though they don't want to become poor, but they have the mindset that will lead them to poverty. Professional traders, we trade until we die or retire. You can see cases like look at George Soros, look at Warren Buffett. Okay, so if you are a professional trader, you know how to invest your money, you know how to trade your money, you can do this forever, right? Once you know how the markets really work, once you know the system, how to use your system, you have a proven concept that's been working for years, then you can be a professional trader. You can keep doing this forever. Okay, so look at George Soros, is already over 80 years old. Warren Buffett already over 80. So all the professional traders can do this forever until they either die or retire. On the other hand, retail traders, they blow up their accounts. So they will do it, they will end up blowing up their accounts, and they will end up giving up. They'll just say, oh no, this is not for me. I just blew my account. I'll give up this mess. This is all fake. The financial markets are fake. Nothing works. It's all about luck, right? They don't understand how the market really works. So they blame everything, they blame on luck. They said this is all luck. But that's their way to find an excuse not to be successful. Look at brokerage firms. So the brokerage firms, the brokers will benefit from professional traders because by the end of the day, after all, right? When you think about brokers, they'll charge a spread and they'll charge commissions. So they'll make some money out of professional traders. They'll also make money from retail traders because they'll also charge commissions and spread from retail traders. So for the short term, they will make money, but after a while, almost all those retail traders, they will give up after blowing a few accounts. They will give up trading. So in the long term, it's not good for the brokerage firms either, okay? Well, if you think about that perspective, of course, if you think about non-regulated brokers, of course, they want to catch as many sardines as they want because they're non-regulated, and it's all about really cheating their customers. And we are going to take a look at those non-regulated brokers. We're going to take a look at that soon. I think all of you have heard of the website, the thread on Reddit called Wall Street Bets. They have 9.5 million followers, okay? So when you think about 9.5 million, think about that number, and you think, okay, so do all those 9.5 million people make money? Did they make money with the previous GameStop trade? I don't think so. I don't think so. Actually, I think most of them lost money. But let's take a look at what happened. So for those who don't know, so the Wall Street Bets is one of the biggest threads on this site called Reddit. Okay, it's a social community where they exchange many ideas, not only for trading, it's for the general purpose. There was this company called GameStop a few weeks ago that they were talking a lot on that thread on the Wall Street bets. The price originally was being traded at 18 US dollars, okay? And what happened is that they artificially tried to pump this by telling all their followers, all those 9 million, but before it was, I think before they just had like 4 or 5 million, but anyways, now they have 9.1, so they tried to pump this stock by telling all their millions and millions of followers to buy this stock. And what happened that once they succeeded, okay, so the GameStop, it went all the way to 480. So it was, the price went all the way here to 400 from, so it was from $18, just $18, price went all the way up to $480. Okay, so it went all the way up here, and they succeeded once. And you know that everybody, I always say this, right? I always say that everybody at least once will have their 30 seconds of fame. And this is exactly what happened in this stock, because you know, for many years, the sardines always lost money. So imagine that all the sardines got together and the sardines said, okay, so this will be our moment. Now we're going to knock them dead, okay? So make them all, how can I say? All the market makers were making a lot of money, but today is our day, the sardines revolution, okay? So let's fight those big banks. Let's fight those big hedge funds. Let's fight those big financial institutions. And they had their 30 seconds of fame, or let's say 1 day or 2 days of fame. So after that, you can see the price went all the way up to $480, okay? And what happened next? What happened next is that if you were following that thread on Reddit, the Wall Street Bets, you will see posts like, oh, we all in, let's put our money here because this is going to go all the way to 1,000 US dollars, okay? So you heard a lot of gossip that said, oh, you go all the way to 1,000 US dollars. This is the revolution of the sardines, yeah. So people said, all in. So you had here a lot of people putting all, when your price was already very, very expensive, right? It was like 480, and you still would see people putting money in at that time, expecting price would go all the way to 1,000, right? And you wonder why people will still put money in. Well, because that's what they heard. And, and you know, guys, I always say this, okay? So what kind of people started to put in? And you will find people who never traded the stock market before. They have no prior experience. They don't know the stock market. Like they may know the stock market by name, but they never traded the stock market before. But once they saw that thread on Wall Street Bets and people were making millions, or at least claiming that they were making millions, right, in a few minutes. And then you started to see all these people that never traded the stock market before opening positions on GameStop. What kind of people are they? So you will see your aunt, your Uber driver, the cleaning lady of your building where you live, right? A retired elementary school teacher. So, imagine all those people, right? That usually will never talk to you about the stock market. But now, right now, they're talking to you. Hey, GameStop will go up, right? And you get so surprised because you ask them, hey, you never traded, I didn't even know you traded stock market. How on earth are you telling me that GameStop will go up, right? So people who don't, and I wrote here, people who don't usually trade the stock market went in. And you know what you should do when your aunt goes in, when your Uber driver goes in, when the cleaning lady goes in, when a retired elementary school teacher goes in, when all those people who don't trade the stock market, they go into that single trade, okay? GameStop single trade. You know what you do? You get out. That's what you do, okay? And what happened on the next day? What happened on the following days, what happened is that it didn't go to $1,000. Instead, it fell all the way down to $40, okay? And if you ask me what's going on again right now is that price after that bounced back again. So now it's being traded at 246, but this, you know what I want to explain to you, right? So these guys, it doesn't really matter. Doesn't really matter if it goes up or down. What matters, what I'm trying to explain to you guys here is not even that, right? So the market goes up and down. That's the rule. The market moves into some forms of waves, and everybody knows that. Everybody knows that if something goes up, there is a correction, then goes up again, another correction. So people know the market will go up and down. Everybody has that kind of idea. But the thing is that the sardines will enter when things are really expensive, and they don't know that, right? They don't know, and after those, the pool, and we even have that term in in the financial market, we even have that term called pool, okay? So when all those sardines enter the pool, and the pool is full of sardines, that's exactly when the price goes down again, okay? And goes down all the way to here, once again, $40, cutting the position that probably your elementary school teacher entered, probably your aunt, probably that Uber driver entered, okay? And they lost all, if not all, a lot of money. One thing that I always say here is about your teacher. Try to remember Mrs. Smith, your teacher from elementary school, and why most of us don't know how to trade the markets, okay? So this thing comes all the way back when you were a child. Remember, I named her Mrs. Smith, okay? But you can name her any name you want to name her. So you're teaching elementary school. Do you remember that one of the very first classes of math that you have ever taken? She used to give you this example, right? She used to say, hey, if you go to the supermarket, let's say you went to the market to buy an apple, that apple costs $2. If you buy three apples, how much will you have to pay? Okay? So it's 2 plus 2 plus 2, and you will say $6, okay? And you will get it right. You will get your score correctly. You'll get your accounts correctly. And probably you can get to the second year. Probably Mrs. Smith is going to give you a great score. But there is a huge problem. What is wrong with this class is because if you think about this class, you will see that there are words here. For example, how much you have to pay, or if you buy, okay? So the focus is the person as a consumer, okay? Using these keywords to buy, to spend, and will consequently will lead you to a decrease of capital, okay? So since we are very young, since we are still kids, we are conditioned to spend money, okay? From childhood, we are conditioned to spend money. We are conditioned to lose capital. Even though you don't realize, like, but in your subconscious, you're being conditioned to do that. And why on earth did Mrs. Smith do that? Why did she do that? It's because Mrs. Smith has no financial education. And what would be the correct approach for this? The correct approach would be, if you are the supermarket, if you are not a customer of the supermarket, but Mrs. Smith should have told you to think that you are the supermarket. Because if you are the supermarket, okay, there is an apple and your supplier will sell it for $1 and you will sell it for $2, okay? So 2 minus 1, you made $1 per each apple that you have sold. So if you sell 3 apples, how much money will you make? And then you would say $3. And that is a big change. Why? Because this time, what has changed? This time, the focus is at you, but you being an enterprise, you being a seller, and the keywords here change from buy to sell, okay? From spending, it changes to profit, to make profit, and leads you to have an accumulation of capital, okay? This is very important. So I always say that we have a big, I always say this to people, we have a big problem in our education. Our education system doesn't condition us to think as business people. Our education system only conditions us to think as consumers. Why? Because that's the model that Mrs. Smith was conditioned. When she was a student, she was conditioned to think that way. All right? So Mrs. Smith, your elementary school teacher, can only think that way because she was taught that way as well. And what should change here is let's start to think as an enterprise. Let's start thinking in order to make money. We have to think from the position of the ones who are making money or already making money, right? So think from the position of a seller, think from a position of a supermarket, think from the position of an enterprise, okay? And that will lead you to accumulation of capital. So let's talk back once again about the financial market. So let's think as a broker, right? How much money do I need in order to start my own broker? I need at least from 30 million to 50 million US dollars. I'm not talking about non-regulated brokers, because if you want to establish a non-regulated broker, you need much less. There is a rule called 90/90/90, so it's often abbreviated as 90-90-90 rule, which means that 90% of retail traders, the sardines, the losers, will lose 90% of the margin deposited within 90 days of trading. Okay, sometimes it's even worse than that. Sometimes even shorter than 90 days. But anyways, we have this 90-90-90 rule that says 90% of retail traders lose 90% of their capital within 90 days. So the vast majority of the retail traders blow their accounts within 3 to 4 months based on this 90-90-90 rule. Brokers spend between 30 to 50% of commissions, spreads to market and gain new customers. For example, the broker, let's say that you have a broker. So the broker that has 10,000 customers, between 90,500 customers lose money. Okay, so let's say between 8,000 to 9,500 customers lose money. That will be from 80% to 95% of their customers lose money. So the broker can't grow business unless increasing their marketing spending, okay? And why is that? Is because within 3 to 4 months, they will blow up their accounts and they will just give up, okay? So once those customers give up, as a broker, you need new customers to keep your entertainment, your business running, okay? In order to keep your business running. So let's think about this business, okay? So once that you are a broker, okay, and once again, I said, so the broker has 10,000 clients, 80% to 95% of them lose money. Being the broker, what would you do in the above case? Okay, so in the case above, in this case, what would you do? Think for a while, okay? So I would like you to think for a while what you would do. And what happens is that, okay, I'll give you a few seconds. Okay, so you think for a while what you would do. Okay, 1, 2, 3, 1, 2, 3. Okay, so now here's the answer. So if you are the broker, The broker does the opposite of what they do, okay? So it takes the opposite direction of their trades. So let's say that the sardine, the loser, the retail trader bought something, okay? If he bought something, he or she bought something, you take the opposite direction and you sell it something, okay? So every time you take the opposite direction of what your clients did, because if you take the opposite direction of what your clients have done, you know that there is 80 to 95% chance that you're going to make money. Okay, as simple as that. So there is a huge conflict of interest here because this is a narrative created by an industry conflict between traders and brokers that position themselves in a certain way because they want events to happen that way, okay? And you can't blame, you can't really blame, I know that a lot of people after I say this, that brokers position themselves at the opposite direction of what you have done. And a lot of people say, oh, Japa Rico, how can brokers be so bad? But come on. That's all based on statistics, okay? And they're all automated scripts. It's not that the broker keep an eye on you, okay? It's not like, though the broker has on the other side of the internet, the broker has a person. Every time you push a button, the bank, the broker staff is pushing the opposite button. No, nothing is like that. Everything is automated, okay? So there's no person in the broker pushing or opening a position against your position, okay? There is not, everything is done by robots, okay? Everything is automated scripts that are being run by the broker, okay? And they have no other option because statistically, because they have a system, and the statistics show that these statistics show that from 80% to 95% of their clients in this example will lose money. So why not create an automated script to go against all those trades? It's common sense. This is how the industry works. So there is conflict of interest, how the industry was made for you to lose. The broker makes money based on spreads, commissions. OTC is over the counter, okay? It's not controlled by the exchange. It are prices that are controlled by the broker. So OTC gain is over the counter gain based on prices that are stipulated by the broker itself. So the brokers take the opposite direction of the traders' positions. The profit of a broker is spread plus commission plus OTC gain, which is what I just explained to you guys. But that's not all, okay? So this false narrative goes on and continues. Things get a little bit worse now because that's not all. So now they are using fake gurus, okay? So social media is full of the so-called fake gurus on Instagram, YouTube, and so on. So and usually they show importer like very fancy cars. They are in their early 20s. They're young people in their 20s, and they show like imported cars and very good lifestyle, very fancy lifestyle, and they show you fake results. Okay. Because any person can go to a browser and edit values in a browser, as you can see in this picture. Okay, you can edit fake results. You can show like huge stacks of money bills, and that's how they do in order to cheat you, in order to convince you to join their fake course. Okay. And let's be more convincing. Let's show a helicopter. A lot of fake gurus, they like to show a helicopter because helicopters are also a symbol of wealth, right? So people who own, oh, this guy, he owns a helicopter, he must be rich. He must be making a lot of money from the stock market, even though it looks like hard to believe, even though he's still in his early 20s, right? Hard to believe, but wow, he's showing on Instagram, so why not, right? And of course, this story continues by showing fake results of the trading platforms that can be easily edited by anyone. and huge stacks of money bills, a smiley face next to an imported bottle of whiskey, and let's try to be a bit more convincing. That's what they think. And why not having a photo of yourself riding your private jet? Okay, showing off your private jet. Not many people have private jets, right? So, as a fake guru, why not showing yourself inside a private jet just to make things more convincing? What do the fake gurus have in common? Most of them, not all, but most of them are in their early 20s. They're non-educated, okay? Oh, here there's a typo here. It should be educated. So they're non-educated. It's missing a D. And they're poor. At least they claim. They claim to have come from a very poor family, and then they claim to have made millions after they have learned how to trade the stock market. Usually they are non-educated. They didn't go to college. Okay, some of them don't even have a middle school diploma, and they're very young. Why do they show? Why most of them they want you to look at them and see this kind of figure? Why they want to show, like portray themselves as being non-educated and being from a poor family? It's because they want to sell you the fake. They want to sell you this very fake image that they are in their they're in their early 20s, which means anyone in any age can learn, right? So even people who are in their 50s, people who are retired, they'll think, oh, this guy is only 20 years old. So if he can do, why can't I? I can also do, right? Because, okay, early 20s, non-educated, because if they show off as being non-educated, it also means that anybody, or even people who didn't go to college, can easily learn how to trade, right? And if they show off that they're from a poor family, so that means that your background doesn't matter at all. You can be from a poor family, you can make money too. So they want to show off this fake image that anyone from any social background, from any education background can easily become a millionaire. And we know very well that it's not true. And another thing that happens is that they try to sell to you this quick, rich scheme, like get rich quickly kind of scheme. Most of them, if you take a look at their history, at their background, you see that they are people who, before doing this, they used to run pyramid schemes. Okay, most of them. I will not say all of them, but most of them used to run their own pyramid schemes. Multi-level marketing companies as well. Most of them used to do or are still doing binary options. Okay, for those who don't know binary options is something that you just have to know if price will go up or down. So if you enter at a certain price, let's say you enter at $100 for the next 5 minutes. So you just need to know after those 5 minutes are expired if price is above or below your entry price of $100. Okay, that's all you need to know in order to make money in binary options. So you may think, oh, Japa, it's so easy, right? So I just have to know if it's up or down, okay? But hey, think about it, right? I'm gonna ask you, there is another thing, okay? If you think apart from binary options, there is another game where you just need to know two things, if it's one thing or the other, which is in a roulette, in a casino. If you go to a casino, you play roulette, right? So you can bet on the blacks or the reds. So if it goes black, you earn money. If you bet on the red and it turns red, you earn money too, right? So there is only two choices, black or red, okay? So this concept of binary options came from the casinos, right? And people may think, oh, it's so easy because it's only two choices, so we can make money, right? 50 and 50. So easy, right? Actually, no. It's not like that, okay? And it's not even 50, because even when you are right, there is a term called payout ratio, which is the percentage that you receive when you are correct. And it's not 100%. There's always like 70%, 60%, sometimes 90%, but it's never 100%. And why it's never 100%? Because this game, okay, I even call it binary options a game, but anyways, I call it casino, but anyways, binary options was made for you not to win, not to earn money, was made for you to lose money. That's why they took this concept of payout ratio from the casinos, they implemented into binary options. Yeah, so most of those fake gurus, they'll be traders, so-called traders of binary options. And the only thing that actually they do very well, that they really know what to do, is they have very strong digital marketing skills. Okay, they all know digital marketing very well. And they have to, because they have to make a lot of fake results and post them on Instagram, on Facebook, on social media websites. So they have to know how to edit, how to make use of Photoshop, Final Cut, Adobe Premiere, Adobe After Effects. So they know all those pieces of software very well. So the fake gurus and non-regulated brokers. Most of those non-regulated brokers, they're based in St. Vincent and the Grenadines. For those who don't know, it's a small island in the Caribbean where there is no law in order to protect the consumers. There is no law in order to protect the clients of these so-called non-regulated brokers, okay? So even if you get scammed or you get cheated by a broker, if you have any kinds of issues or problems with your broker, if your broker is based in this island, there is no way to recover your money. And these non-regulated brokers, they have a partnership, they give affiliate programs to those fake gurus. So those fake gurus are affiliates of those non-regulated brokers. Some of them also give you IB introducing broker contracts. And if you are a fake guru, you can receive up to 40% in commissions. Okay, so every time, let's say you are a fake guru and you invited someone to join this non-regulated broker, every time your client, let's say client, or the one you claim that you taught how to trade. Anyways, every time your client loses money trading in this broker, the broker will pay you up to 40% of that amount in commissions. So it's a huge, right? It's a very big fat, very, very big fat commission, a very big piece of the cake, I would say. So many of these boys, many of these very young boys in their early 20s, they want to join as affiliates of non-regulated brokers because they want a cut of that commission. So they want to have up to 40% commissions based on every time that you lose a trade. So never join those fake gurus. So in summary, let's go back here. So in summary, guys, using spread, commissions. Oh, here is still in Portuguese. Sorry, I forgot to translate that to English. So, using spread plus commissions plus fake gurus, all those non-regulated brokers, they encourage retail traders to open bigger and bigger positions so that they can make bigger and bigger money on the retail traders' losses. That's how it works. How this market works in summary. Okay. And how do fake gurus make money? So there are 5 ways that they make money. One way, as I explained before, is by receiving commissions from the non-regulated brokers. Another way is by selling their I wouldn't say stupid, but their lame trading courses that don't teach you anything. Okay, most of those courses you will not learn. Actually, you will dislearn. Okay, you dislearn. If you knew something, you will forget by taking those weird trading courses. You'll just lose your money, plus you will lose your time. Okay, time is very important, but by taking those fake courses, fake trading courses, you lose your time too, not only your money. Okay. Another thing that the fake gurus do is to provide copy trade services. So basically they have a robot, or it's even sometimes themselves that claim to open several positions a day. And there is a script that runs and copy all their trades, and they open all those trades in your account and automatically close those trades. Okay, so people will think, oh, why not, right? This fake guru makes millions, so why not applying for his copy trade service? But once you apply for it, you'll find out the reality. And the reality is that they don't make money by trading at all. They just lose money, okay? And because they have the agreement, they have the affiliate program, they have the IB contract with those non-regulated brokers, because of that, those copy trade services will only lead you to lose and to blow your account. You lose your money, you end up blowing your account, because that's what they want you to do, so that they can get up to 40% in commissions. Signal service, trading chat rooms. So those fake gurus also provide signal service chat rooms where they send you a whole bunch of crap. Yeah, whole bunch of signals, whole bunch of crap. You believe that crap works because you're still believing that there are very good traders, and you follow those signals, you will lose all your money. Once again, you blow up your account. And the last but not least are trading bots. So trading robots. And people will still think that the fake guru makes a lot of money. They'll apply for those trading robots, but those trading robots will also lose a lot of money and will make you end up blowing your account. So these are the 5 ways that fake gurus make their money. But why are you telling us all these things? And this is what people ask me, right? They say, hey, Japa, but why are you telling us this? How the market is structured? Because you need to understand how the market really works, which is the meaning of this abbreviation, HTMRW, how the market really works in order to become profitable. Okay? And this happens in every industry. It's not only in the trade. Not only in the trading industry, it happens in every industry. Who here has ever opened an account in a broker? Have you guys ever opened an account with a broker before? Because if you have, right? If you have, you know this. What did you need? Okay, so you needed your passport, a government ID, like an ID issued by a government, a photo, and a signature. That's all you need, and maybe in 10, 15 minutes you can open an account. And why did they make it so easy for you? Are they trying to be your friend? No, they want you to open an account as soon as possible, make things easier. Have you ever read the small letters in the contract? Okay. So before I said they require your signature. They require your signature in their contract. But have you ever read the small letters in the contract? They're written somewhere, okay? If you look for those small letters, you find something that says, I am okay to lose all my money, okay? Of course, it will not be written like this, but after all, the meaning is pretty much the same as this. Okay, so somewhere, if you look at those contracts, it's written somewhere that I'm okay to lose all my money. Please sign here, and you sign it, and it's written in the risk disclaimer inside the terms and conditions. Okay, so that's it, guys. Welcome to trading. A market where it's full of deceitful content, full of cheating, full of things that are going to go against you, and full of 90, 90, 90, which means the 90% of all traders lose 90% of all their capital within a time length of 90 days. Okay, and if you still want to come to trading, welcome to trading, but be aware, keep in mind that this is not easy. I always tell people, I always tell my followers, if you think this is easy, okay, if you think you can just take a course, you can just take a course for a few hours and you'll be able to trade and make money. If you think like that, give up. Okay, this is going to take you many years in order to be profitable. I would say a few years. Okay, people say, oh, Japa, can I learn how to trade in a few days? And I say, no. And then they say, oh, a few weeks. No. A few months. No. It's going to take a few years in order to become consistent. Okay, because if you're not consistent, you will end up blowing your account. Okay. If not today, tomorrow, maybe a few weeks later, but you will end up blowing your account because you don't have a system that has been proven to work. You don't understand the rules. You don't understand the 90, 90, 90 rule. You don't understand how the market really works. So I hope with this explanation, you finally, at least I helped you a little bit to understand how the industry works. And that's it for today, guys. I see that we don't have any questions. So thanks for watching, and I'll see you guys in my next video. Thanks for watching, and goodbye.